Hello ladies and gentlemen, welcome to my channel. My name is George Kingori and I'm your online finance guy who speaks about all things finance, how you can be able to grow, how you can be able to invest, and how you can be able to grow your financial outlook. Ladies and gentlemen, today we are going to speak about how you can be able to invest in the financial market, how you can be able to ride the wave when things go down, when things go up, how you can be able to not only grow but thrive, ladies and gentlemen. And before I speak about these things, I need for you to understand that the stock market is like the currents of an ocean, ladies and gentlemen. There was a guy, let me start with a story so that you can be able to understand and grasp. There's a guy who took into rowing from South Africa to South America, to Brazil, ladies and gentlemen, and this guy had done the calculation, and people could not imagine that somebody could row their boat across an ocean and they'd be able to get from the south continent of Africa and into South America. Ladies and gentlemen, this guy understood the times, and that is why he planned the journey. Many people applauded him and said, "Oh, you have done a great job. You have done such a wonderful thing." But the only thing that this guy needed to plan for and understand is that the ocean currents move from the south coast of Africa and into the east coast of South America in Brazil. This guy understood and was able to ride the waves with his boat. And the only thing that he needed to do was to be able to ensure that he does not move from another current that moves away from the coast of Brazil. This guy planned and rode the wave and was able to work with the current with minimal input, with minimal effort, with less danger, and was able to ride from Cape Town down to South America and to Brazil, ladies and gentlemen. And he was able to make the journey with minimum effort, with less danger. And a lot of people applauded him. But ladies and gentlemen, he is one person who can be able to master the stock market. So what did he do, and what can you be able to get from this story so that you can be able to know how to ride the stock market current? Ladies and gentlemen, the stock market goes up and goes down. So ladies and gentlemen, you need to understand that you need to ride the current. You do not need to go against the current. You do not need to do anything, but can be able to ride the current and be able to improve or the outlook and your growth in your finances in the stock market. When the market is high, ladies and gentlemen, that is when you sell. When the market is low, that is when you buy. Why? Because the buying price when the price is low and the selling price when the price is high, that is where you make your margin. That is where you make most profit and the capital margin. Ladies and gentlemen, that is where people make wealth in the financial market. When the stock market has a dip, ladies and gentlemen, think of them as dips and up and spikes. So when it is on a spike, that is when you sell. When it is on a dip, that is when you buy. When do you buy, ladies and gentlemen? And what kind of stocks do you buy? There are several classes of stocks and ETFs. The safest you can be able to do is go with index funds and ETFs. Ladies and gentlemen, for you to be able to invest effectively, you also have to look at where the market is, ladies and gentlemen. When it is going down, ladies and gentlemen, that is when you need to prepare your finances to be able to invest in what is called growth stocks. These are stocks of companies that grow exponentially and usually include tech stocks, clean energy stocks, electric vehicle stocks, and things that deal with technology. These are the kind of shares and investments that are called high growth potential shares, ETFs, and index funds. That is the amount of money that you're going to invest, and that is where you're going to invest. Why? Because they are the ones that drop in price the quickest. They are the ones that people sell out when there's a market dip, and they're the ones that you need to buy. So you have your money. When do you buy? Look at the chart that you have in the stock market. Look at the lowest price in the last financial dip. If, for example, the price was $25 or 25 euros and your current market price is 50, do not yet buy. Allow for that market price to go down. In fact, you can actually set up a buy order in your stock brokerage account, you can be able to put a buy order and be able to put the lowest price as, say, 30. Remember, ladies and gentlemen, the previous dip, usually in the current dip, the price will not go as low as the previous dip. Why? Because the stock market usually goes high. So, ladies and gentlemen, put a buffer. So if the last dip, the lowest price was 25, ensure that you put the purchase price in your order to around 30. Ladies and gentlemen, that is almost 20% improvement, because the stock market usually goes down, and the dips, as you go with time and as the future goes, the dips are not as low as before. So when you look at your chart, the dips in the previous years are usually lower and lower and lower, and the dips in the future periods are usually higher and higher and higher. That is why I'm telling you, if the lowest dip in the previous time was 25, now you need to work with 30. So put an order in your stock brokerage account and say buy when price gets to 30, because that is a reasonably good figure. So when you say buy when the stock market gets to 30, then by the time the market comes to that price, you are able to buy your stocks, ladies and gentlemen. And I have said high growth stocks, technology, clean energy, growth stocks, usually technology shares, ETFs and index funds. That is when you buy. So you have bought at the lowest price. Then you wait for the price again to go up. And then as you wait, the time that you sell is not when the highest spike was, the previous spike was. So if the spike was 50, do not sell at 50. Again, look at another percentage of, say, around 10-20%. Then say put a sell when the price gets to, again, around 60, because the previous spike was 50. Then the previous the price that you are looking at is around 60. That is the next spike. So you put sell at 60. So you bought at 30, and you now put an order to sell at 60. Ladies and gentlemen, you will be able to double your income, 100% income, ladies and gentlemen, from your investments. That is how you ride the stock market. You buy low, you sell high, and ensure that you reasonably make allowance for dips and spikes, ladies and gentlemen. So how do you invest in normal times? When you want to invest in normal times, when there's no peak or dips, how do you invest? This is the time that you invest in high dividend stocks, in stocks of companies that have been in establishment for a long period of time. So the Coca-Colas, the Henkels, the Airbus and the Boeings and things like that. The companies that have been in existence for long. The ones that are established, the ones whose industry and product has been defined, and the ones that have been working and giving dividends continuously over periods of time. So these are the investments that you make in the during normal times. That is when you buy, because these stocks and prices do not spike and dip so high. And as you wait, they reasonably grow, but at a lower pace than the growth stocks. So that is when you buy in slowly by slowly. Why? Because you are keeping these stocks for the long haul. So for the high growth ETFs shares, the ones for the technologies and the clean energy and the electric vehicles are the ones you sell, because you're going to make the prices and the conversions very fast. Remember, ladies and gentlemen, once you sell, you can either keep that money as you wait for the next dip, or you can invest them in these stocks and shares of the established companies that are reasonably going to be in operation even for hundreds and hundreds of years. Those are the stocks and shares that you buy, because the prices usually go consistently high over time, and even if they dip, they do not dip so high. And even if these shares and ETFs dip, they do not dip so far, and they continuously grow at a slower pace, but they grow, and you continuously make your dividends, ladies and gentlemen, because you are not fighting the stock market current. You are going to make your money, you're going to grow your investments, and you're going to benefit every time there is a dip or a spike. Ladies and gentlemen, that is how you ride the stock market. That is where you make your money. Ladies and gentlemen, I do not encourage you to do what is called day trading. That is where you buy and sell in a relatively very short period of time. So ensure that instead of doing that, which is highly risky, and because you cannot reasonably predict prices over a very short period of time, usually work with the dips and the lows as I have estimated, because you will be able to reasonably estimate and forecast how you're going to make your money in the stock market. So ladies and gentlemen, I hope that I've been helpful to you. Even as you continue getting concerned about the stock market, remember, there's always a correction, there's always an upswing, and you will always make your money over a long period of time. You are safe. But ladies and gentlemen, that is how you ride the stock market. That is how you make your money, and that is how you're able to improve your financial outlook. So remember, if you like this video, leave a like on this video. Remember to write a comment down there and to subscribe to my channel so that I can be able to put out more content that will be able to be helpful to you as you grow in your financial journey. So thank you and enjoy your day.